Thank you all for having me. I've seen maybe 200 Park Street Universities on YouTube in my time, so to stand up here today is a nice little kick and giggle. Appreciate you all giving me the opportunity. Connor McKenna, I work with Pronghorn Investment Management. We actually help out. We have a broader organization mandate to build a scalable template for how to diversify any industry, starting with spirits. One half of our organization is all about helping you find the right talent, making sure they're trained up and successful and retained once in role. And then luckily I got the team right here. Our side of the business is more like a venture capital fund. We invest in spirit brands. We look to provide not just capital, but network and know-how to help brands navigate this three-tier system and try and accelerate their growth, specializing in that journey from 0 to 25,000 9-liter cases. So I'm here to talk about probably the most boring subject of all these topics, but really strict financial KPIs that are going to help tell you the financial health of your business. I'm sure Brian will be hopefully nodding his head along with some of these slides for what actually matters to us as investors, but most importantly should matter to you all as founders. The spirits industry is filled with cliches like brands are built in the on-premise and you don't drink stories and all these different things. One of my favorite ones is that your cash and your accounts are like a leaky bucket, right? When you are a founder, it doesn't matter how much fundraising you do or how much brilliant sales and marketing you do. If you don't have an efficient cash flow cycle optimization, if you don't have an opportunity to build long-lasting relationships with accounts, you're going to fill that bucket and carry on for 6 months and add a bunch of new accounts and do great marketing campaigns. And then you're going to wonder, why don't I have cash to do samplings? Why aren't my accounts reordering again? So these are some of the KPIs that are going to help you identify where those leaks are, help you patch them up, and make sure you're building a sustainable brand that can withstand the headwinds we're all going through in the industry today. So pretty simple agenda. I think I'd updated these slides, but we're working off of the older version, so I'm going to flow with it. We're going to introduce the cash flow cycle for shipments, overall the cash conversion cycle, some of the strategic levers that you can pull aside for within that conversion cycle, and then we're going to beat you over the head with velocities once again, hopefully give you some real examples of how to actually drive velocities within the market. So you'll have to forgive the 101 subject on this, right? But let's say we're starting a brand tomorrow and I'm going to use big, simple numbers. In this example, we buy all of our raw materials and create our inventory, right? That's our first actual vendor that we're partnering with. What's going to happen sometime likely in the next 30 days is we're going to pay them for that. Let's assume a nice even number of $100. That's the first time cash is going out of the business. We're going to take that inventory and try and sell it to a distributor, get our first purchase order. Incredibly exciting moment, but no cash tied to it, right? You now have inventory in your distributor, in your partner. As Brian was saying before, you now have the job of actually getting that into an account. But first, you got to collect that cash, because getting that money, getting those products into account and getting those products pulled out of the account is going to require everything that we've been talking about: your sales reps, your marketing expenses, your sampling events, etc. A quick little quiz here, because I think markup and margin often get very confused in this process, but we're using big numbers. If we bought $100 worth of product and sold it for $150, what's our markup? 50%, right? What's our margin? 33%. 33% may sound great if you're in other industries. In the spirits industry, it is very, very capital intensive. You want to make sure you're above 50% here. These are the kind of calculations and numbers you need to know. So when you try and put stress in these P&L levers, how much can you offer incentives? How much can you try and negotiate your supplier terms? All boils down to that gross margin figure. So when we talk about the cash conversion cycle, Maria literally wrote the book on this for distillery finance. So I feel a little bit imposter syndrome standing up here right now. But I'm sure she'll correct me where I mess up. There's 3 core components of this cycle. So first, you are selling inventory. That's how many days of inventory you have on your balance sheet. Next, you are collecting the cash from your sales. That's how many days it takes you to actually get cash, most likely from your distributor partner. And then you have to pay your bills. So that's how often you're paying your vendors, whether it's the marketing agencies, whether it's your co-packers and manufacturers, etc. The calculations for these KPIs are pretty straightforward. I am going to speed through this through the interest of time, but I would say, again, team in front of me, we're blessed to work with some amazing individuals. This is all that we think and talk about, all that we try and help our founders with, so please find us after the session. We can dive into it, right? But the core goal here is we're coming up with a certain number of days, right? How many days of inventory do we think we have on our balance sheet? How many days of sales do we have out there that we're looking to try and collect? and how many days on average does it take us to pay the people that we owe money to. Maria would probably kill me if I didn't say this right, but we are comparing balance sheets and income statement items right now. So it's really important that you're looking at comparable time periods. You're working with a great bookkeeper, someone who can help advise you on this, and making sure the actual outputs from these calculations on your financial dashboards that you should be reviewing on a monthly basis at least are accurate and helping you drive the right strategic decisions. So what are some of the levers that are available to you here in this process? Oh, I should say, there was a different slide here, but ultimately you're going to get to a number of days, right? And what we're trying to do is make this number as little as possible, right? I think tariffs are changing this right now. A lot of our founders are being forced to buying 12 months of inventory because they just have no idea where these costs are going to go. But ideally, you don't want your cash tied up in inventory sitting on the balance sheet. Here, you want this to be as small as possible, right? If your distributor owes you $1,000 and that $1,000 you're counting on to drive sampling and liquid to lips activations, you need that in your pocket, or you need to kind of broker some relationship where they're co-investing alongside you, and you have to pay everyone. I'm not saying you can't. I think if you're that you won't or you shouldn't. If you're an early stage brand, realistically, you can't walk into a distributor and say, yeah, you give everyone else 30 days, but I'm net 60, right? The only way you can really start to get some leverage in those conversations is become a much more meaningful contribution into their P&L, and that's where you're gonna start to get some leverage. So we'll talk through what are some of the levers. This honestly is what we spend a ton of time doing. We just ran off our annual operating plan process with all of our portfolio companies. It really boils down. Payables, you can't do too much with, right? You're most likely working with a multinational or a large distributor and a large co-packer. Their terms are their terms. What can you control? Your demand planning. How much demand do you think you can generate in the market with yourself and your sales force for the next 6 months? Use that information to determine how much inventory you need to be keeping on your balance sheet. Some risks here, again, tariffs, port closures, force majeure activities. Out of stock can be a death knell for a brand, right? You don't want to go do all this marketing work and then have distributors being like, hey, it's actually selling great. When can I pick up my next order? 3 months from now, right? That momentum can be a death knell. So just speaking out of both sides of my mouth now, but demand planning, incredibly crucial for the business. Your key takeaways, you want to keep your cash conversion cycle as short as possible. Cash is absolutely king. Mistakes drive major concerns for you all, right? If you don't have cash on hand, you're forced to resort to credit card debt, you're forced to resort to lines of credit or factoring your receivables, all of which is going to reduce the amount of cash you should be receiving. Simple flow of inventory through the system. This is 101. Everyone should be very familiar with this. Again, you'll get these slides afterwards. P&L 101. This is how we investors look at it. This is how we recommend you set up your chart of accounts as you present this information to investors and advisors. But what are the metrics that matter? Let's focus here on the commercial side of things. And I'll give a real quick example of the brand Guinness to help try and bring this into everyone's mind. Let's focus here on the commercial side of things. Point of distribution, a single SKU and a single account. If you're a tequila and you have a Blanco, Repo, and Añejo, and a store carries all three, you have 3 pods. If you're Guinness and you only have 1 SKU, you have 1 pod. Retention rate is how many accounts order year after year after year. Benchmarks for this, you want to have at least 50%, right? Again, it's a leaky bucket. If you're doing all the sales activities and opening up 1,000 stores in 2025, but in 2026, you can only count on 400 of them sticking around, your activities as a sales rep is like this insurmountable hill. You have to build lasting relationships, and you want to be driving that reorder rate. My last example, because I feel like I have to share this before we kill time. Guinness is an amazing example, right? I'm fairly Irish. St. Patrick's Day is one of my favorite days of the year. I can guarantee that every bar in New York is going to have a keg of Guinness on hand. Their retention rate is off the charts, 95% plus. Unless the bar closes down, you know that bar is going to order Guinness every single year. What happens 2 weeks after St. Patrick's Day? Sun starts to shine, people aren't really drinking stout anymore. How do you think their reorder rate looks like on a month-to-month basis, right? Would you take that business model? Probably, right? But the sales team of Guinness has this unique challenge of how do we create demand and consumption occasions beyond that one day? How do we leverage this retention rate and relationship with customers and force consistent throughput? And you all as founders need to be thinking through and focusing on that exactly, right? As your product flows through this system, Brian said it perfectly, right? The old way of the models of being able to count on your distributors and sales teams to do this for you, are a little bit challenged at this point in time. So how can you make sure, again, focusing on these KPIs and focus points, how can you make sure you're building lasting relationships? You don't care about that first order, you care about that fourth order. And me as an investor, I care about that fifth, sixth, seventh order, and show that you know exactly what accounts you do well in, you know exactly what channels you do well in, how to sell in, and how to market that brand once it's on shelf or in the back bar. Velocity over volume all day long. We'd rather 1,000 cases in one market than 5,000 cases in 10 markets, right? The more you can concentrate your efforts, the more you're going to learn about what works well for your brand, and the more you're going to be able to scale that playbook. Thank you so much.